John Kosar from Asbury Research, and this is the Asbury Approach to Investing video for December 2022. You can subscribe to these videos below. The purpose of these free monthly videos is to introduce professional and private investors to our unique data-driven approach to investing and quantitative models. The slides for this video were taken from a much larger and more detailed monthly report, one of many different reports that we produce for our paid subscribers. All Asbury Research reports and models answer two primary questions. Number one, should I be invested? And if so, how much? Number two, what parts of the market should I be invested in? So let's begin. First, just a little about me. I've been in the markets for over 40 years. I launched my career in the early 1980s on the floor of the Chicago Mercantile Exchange in Chicago and spent the next 17 years there really developing my approach in a very practical way. Being with traders, watching how different people trade markets, watch how the markets move together, watch the interrelationships between the various markets that were being traded on the trading floor of the Chicago Mercantile Exchange. I'll let you read this on your own time if you're interested in a little bit more of my bio, but this is what I've been doing for the past 40 years. What we do, our approach is purely data-driven. We're not trying to forecast markets. We do very, very little forecasting. We are trying to read the data, watch the money move around the investment space, and try to determine where the money is going. And when the money moves, we move right along with it. Basically, what we're trying to determine is when it's time to be aggressive and fully invested, and we call this risk on. When it's time to be defensive and protecting your capital, we call that risk off. Which parts, again, of the financial landscape are performing best, which sectors, industry groups, and individual stocks to buy, and which ones to avoid, where the opportunities exist in global markets, which sometimes are a very good alternative when you have a year like this when the S&P 500 is in a bear market. And finally, where the best opportunities exist in a broad array of ETFs. And we track the asset flows, the AUM, moving around these various ETFs to see where the money's going. How we do it. We do this using our basis, our starting point, really our foundation is our own quantitative models. We have the correction protection model for wealth preservation. We have our Asbury 6 model for risk management. We have our SEAF model, which stands for sector ETF asset flows for sector selection. We have our CARP model, which stands for cross asset relative performance. That's for domestic asset allocation. We have our US versus the world model for global asset allocation that I just spoke of. And finally, we have our sector and industry group momentum model that also incorporates relative performance. So let's begin with CPM. CPM is our oldest model. I think that's probably been in existence now for close to 15 years. CPM, I first built CPM more than 10 years ago at the request of a lot of our RIA clientele who are managing money for other people. Those other people are typically older, they're wealthy, and they're a lot more risk averse. They're a lot more concerned about trying to keep their capital rather than going out there and taking a lot of big risk like you might do if you're 30 or 40 years old. So we built this model that basically lets investors trade the markets. Older, again, wealthier, more risk-averse investors participate in the stock market with a lot less risk. So just here's some performance. Here's some back-tested hypothetical performance for the CPM. So this is the CPM here on the left side using SPY to trade those signals. And SPY, of course, is the ETF that tracks the S&P 500. So you can see since 2011 and through the third quarter of 2022, on average, it's underperformed the S&P by 1.7%. So you might ask, why is that good? it's good because if we look down at the bottom table here, it has done that with a beta of 0.44. This is versus a beta of 1 for the S&P 500, which is the benchmark. It's the bogey. So according to beta, it's less than half the risk. Let's look at maximum drawdown here. I'm pointing to it. Maximum drawdown during that period from, again, 2011 through the third quarter of this year, the maximum drawdown following CPM and using SPY is only 15% versus 34% for the S&P 500. You can see your standard deviation is only 8.9% for CPM during that period, as opposed to 14.3 for the S&P 500. So then what we did is we said, what happens if we build in some of the risk back into the model? And we did that by trading the CPM signals with SSO, which a 2 times leveraged S&P 500 ETF. And you see this information is here on the right. So now you can see our average annual performance, again, hypothetically backtested to 2011, is 6.3%. And that, adding the beta back in, it pushed the beta back to 0.88, still a little bit less than the S&P at 1%. It took our maximum drawdown to 29.5, still a touch less than the 33.9 for the S&P 500, and a slightly higher standard deviation of 17.8 versus 14.3 for the S&P 500. Better Sharpe ratio, better Sortino ratio. So our current signal for the CPM model is risk off as of December 7th. Prior to that, it was risk on, you can see here, on October the 25th. So we have a risk off situation now, which means that we are basically defensive. We are either moving to cash or we are trading our portfolios. We suggest subscribers take this as a sign to do whatever you do when we're in a bear market and you're either taking risk off the table entirely or you're investing in assets that will work better in a bear market. Now we're going to go to the Asbury 6. Our Asbury 6 is an indicator rather than a model, and we use the Asbury 6 to tell us what the day-to-day health of the stock market is, because you can't really determine that anymore by looking at the S&P 500. Way too much day-to-day volatility. It's up 70 today, it's down 50 tomorrow. A lot of that is driven by algorithmic trading. So this allows us to look at the market day-to-day and determine what its internal health is. Very much like when you go to the doctor's office and the first thing he does is put you up on the table and he checks your pulse and he checks your blood pressure and he checks your reflexes to try to get an under the hood indication of what your baseline health is. So right now you can see that we are we are negative here from December the 15th after being positive from October the 18th. Note that our model started blinking, which is what we use, how we describe when the model starts rapidly going back and forth between negative and positive and back again. We had a lot of blinking right at the end of last year and the beginning of this year. That told us that this trading activity at the beginning of the year, it was some kind of a top, some kind of an intermediate term top. It didn't tell us when the last day was, before it actually fell off the table, and that was basically January 14th. You can see it here, but it did tell us not to be putting on any new long positions during the month of December, because we were probably close to some kind of a peak here, and that actually was the trigger that gave us this huge move that was about 25% down into the October lows. So right now we are negative in the Asbury 6. 4 or more in one direction is a signal for the Asbury 6. So you can see right now all 6 of our constituents, which are the rate of change in the S&P 500, the relative performance of stocks versus high yield bonds, investor asset flows in the SPDR, SPY, corporate bond spreads. These are actually high yield corporate bond spreads, trading volume, and market breadth. Right now they are all negative, and the dates that are in here are all the dates that each of these 6 constituents actually turned red. It would take 4 or more to turn to green. or positive to give us a signal that it's time to buy again. Until then, this tells us that we should have our defense on the field and we should be trading these markets as if there's going to be more weakness. Our subscriber version of this actually looks at every one of these 6 constituent metrics individually, so you can just see kind of what they look at from a visual standpoint. Another one of our models is the CARP model. The CARP model shows 8 different equity-related cross-asset relationships. You can see here stocks or bonds, high beta or low vol, large cap or small cap, growth or value, and so on. There's 8 of them. Right now, it's telling us, and it has really been for the past couple of months, that you want to be in these more defensive areas like low volatility over high beta, blue chips over the S&P 500 and over technology. Blue chips have outperformed. Another one is developed markets. Showed up here basically the beginning of November. It showed us an opportunity that we should consider being overweight developed markets versus U.S. markets. And here's how we've done. So here you see the developed market, VEA is the ticker for the developed market ETF. And you can see that VEA has been outperforming the S&P 500 since November the 2nd. It's outperformed the S&P by 8%. So again, in a defensive mode, in a bear market, the CARP is going to tell you where to go to find some relative outperformance, just as it did here. Our next model is our US versus the world model. This looks at the relative performance of the S&P 500 versus 25 global equity markets in 3 different time frames, just as the CARP does. The 3 time frames are trading, which is weekly, tactical, which is monthly here in blue, and strategic here in red, which is quarterly, just the same as we had here for the CARP model. We're looking for trends across multiple time frames. So what you're seeing right now, and this is not typically what you see, is most of these 25 markets are outperforming the S&P 500 in multiple time frames. This has been the case really since the middle to latter part of October. What did that tell us? It told us even though we had the rally from October and November and into December, it told us the rest of the world wasn't really buying it. It was still putting more money to work overseas, which was driving that outperformance. So you can see we have outperformance from multiple places. The most recent trends of outperformance that this model had identified for about the past month or 2 have been in Western Europe. You'll see a couple of them here. This is EWY. This is the iShares MSCI Italy ETF. You can see that it has been outperforming the S&P 500 or SPY since September the 14th on a 63-day basis, which is 1 business quarter. It's outperformed since then by 14%. So this was one that showed up on our model a couple of months ago, that this was a place that we should consider taking some of our capital and allocating it overseas into the Western Europe area. Here's another one. This is the Eurozone, iShares MSCI Eurozone ETF. This has been outperforming SPY since October the 14th. It's outperformed SPY by 13% since then. Again, another one that was picked up on our US versus the world model. Our next model is our CEF model. Our CEF model follows the money around the 11 sector spiders rather than trying to track relative performance the way that US versus the world does and the way that CARP does. This is actually tracking assets within those 11 sector spiders, which together are the S&P 500. So you can see right now a continued trend of inflows into healthcare, which has been for the past 3 weeks. And we've got some new trends just starting. We don't know if they're going to stick yet, but we have some new trends of inflows going into utilities and energy. And you can see those here. Here's utilities. Strength in multiple time frames. Here's energy. We got a couple of green ones here, which is showing strength in 2 different time frames. And here's healthcare, which we've been overweight according to the CEF model for about 3 weeks. Let's look at the chart of healthcare. So healthcare showed up as a long or overweight idea on the CEIF model on November the 28th. So it's about 3 weeks ago now. So far, it has outperformed SPY by 3%. A prior signal in XLV from earlier this year in CEIF, it showed up on our CEIF model on September the 12th, and it stayed as an overweight on CEIF up until November the 7th. We captured 8% of relative outperformance on this particular signal. Here's some facts and figures for the CEIF model. This shows the past 10 quarters, CEIF versus the S&P 500, and it shows that CEIF outperformed the S&P 500 8 of the past 10 quarters. That's why you're seeing, so actually we don't show Q4 here, but so far in Q4 with about 10 days left in the quarter, CEIF is outperforming SPY by a little over 2%. So that would make 8 of the past 10 quarters relative outperformance versus the S&P. 2022 year to date, again, this only goes through Q3, but it shows that in 2022, CEIF has outperformed the S&P by 7.2%. And since Q3 of 2020, which is where we begin up here, CEIF has outperformed the S&P by 31.5%. Here's the good part, especially for me. I'm very conscious about being able to trade the markets with less risk. You can see throughout this period, the beta on CEIF has been 0.89, a little less than the beta of 1% for the S&P 500. You can see the maximum drawdown for CEIF here, 22.5%, a little less than the 25.2% here for the S&P 500. And then you can see a much better up capture and a much better down capture. And generally, much better returns. Our annualized total return for CEIF is 19.2 versus just 10.1% for the S&P, again, throughout that 10-quarter period. And finally, here's the chart. Going all the way back to that start date, the CEIF model is in green. You can see the S&P 500 is in blue. So CEIF overtook the S&P 500 here at the beginning of 2021 and has stayed there. You'll see this year, 2022, the S&P took a big dive. It had a tough year. Here, CEIF model has stayed relatively flat. The reason for that, the CEIF model was overweight. The energy sector was one of the two sectors that was overweight from January 10th of this year till June the 24th, which means, so CEIF for the first half was only down 3% compared to down 21% for the S&P. So basically, we got on the energy trend early because CEIF showed us that the money was moving there. It stayed there for most of the first half, and that allowed us to avoid a lot of this drawdown here that we've had in the first half of the year. Finally, just a little price and trend. S&P 500. It came up to test this major overhead level here throughout the first half of this month. You can see November 1st and 13th were the peaks. We had the February 24th benchmark low here in red. That's a resistance level. We had the major trend line coming off the January 4th high over here in pink. And then the 200-day moving average currently at 40.27. Came up a few times, tried to break it, failed. Now we're breaking through the 50-day moving average, which is the minor trend. It suggests that we should see at least a test of 36.98, which is the November 3rd low, and perhaps a move all the way back down to 35.88, which is the September 2020 benchmark high. We saw that tested and held in the middle of June, and then we saw it tested a couple of times here in late September, early October. So right now we are risk off. We have tested and held the major downtrend, and these are the levels on the way down that I think are likely stopping points for the market. Here's the VIX. The VIX is starting to move above its 21-day moving average. That's Asbury's tactical time period, and where we watch for a shift in volatility. As long as the VIX stays above the 21-day moving average, which it has since Dec the 7th, it shows us that there's a slight increase in investor fear about the market. If the VIX gets up above the 24 area, which is a line of demarcation from us, we think it could actually cause this downtrend from the from the beginning to middle D's highs to actually accelerate downward. This is market breadth, and what I wanted to show here primarily is this is longer term breadth here on the right. This is a percentage of NYSE composite stocks that are trading above their 200-day moving average. See where we are now. We are coming off of an extreme low of 18, which is washed out at market breadth on the 1st of July. Previously, we were down there on March of 2020. That was a COVID low. January 2016, August 2011, Nov 2008, and so on. That suggests to me that even though the market's rolling down from this failed test of resistance, somewhere in here, somewhere near perhaps 3,600, we think that could turn out to be a more strategic bottom. So what we're watching for there is once we get there and our Asbury 6 turns back to green, our CPM model goes back to risk on, we would see that as potentially a larger, maybe longer term buying opportunity that could last a quarter or two. So that's what we're looking for as we head into next year. And finally, we've got some investor sentiment gauges here that I think are important. Two different ones. This is futures trader sentiment, which is a near to intermediate term oriented indication of what retail futures traders are doing. You can see they're coming off of a least bullish extreme that has led to other bottoms over the past several years. This is the investors' intelligence data here on the right, which is more intermediate to long-term survey of market advisors like Asbury Research. We're actually one of the inputs into the II data. You can see that is coming off of a June and an October 7th extreme, least bullish extreme that has coincided with literally every important bottom in the S&P 500 going all the way back to 2010. So again, another reason to think market's under pressure here. Tactically, we are risk off and have been for the past week, but these more long-term indications, including the market breadth indication we looked in the last slide, suggest to us that we are not too far away from a more strategic bottom that could perhaps be the launching pad for the next significant uptrend in the stock market that could last from 1 to several quarters. So there you have it. A lot of information for you. Please feel free to contact us by any of these means with further information, including pricing of our services, what our services include. And again, you can get further information from us by visiting asburyresearch.com, or you can send us an email, or you can contact us, and we will gladly send you this slide deck so you can kind of examine them a little closer and maybe even have it side by side with you as you go through the video presentation. Thank you. Have a wonderful holiday season, and we will come back at you with another one of these